Well, good evening, everybody, and welcome to our second experimental edition of the expected returns, and call it a review webcast, basically focused on providing some highlights of the monthly newsletter, which I've decided to reemphasize for a while and see if it has value. I know it has considerable value to me. We'll see how much value it has to you guys because you'll let me know, and I appreciate any feedback that I get.
Did you hit record?
I did hit record, Herb, so
Good.
So we're underway. So these sessions will actually take place, at least the plan is for it to be the first Saturday morning, kind of a kickback Saturday morning, first Saturday morning of every month, so we can go over the highlights and sections of the newsletter, the various articles. It's basically your opportunity if you have something that you want to discuss or dig deeper into, or simply request a different mode of coverage or whatever. That's the intent. And what we'll do here tonight is just kind of go section by section, hit some of the highlights. Some of the stuff is material, which is, in my opinion, kind of cool, but ended up on the cutting room floor because there's only so much room, on the pages of the newsletter. But a lot of that stuff ends up in the Manifest Investing Forum, and I want to remind everybody about that also. So these will traditionally happen on Saturday mornings, first Saturday mornings of the month, and we'll do them as long as it seems to make sense to do so. I will tell everybody that when we de-emphasized the newsletter and it basically disappeared for a while, with just portions of it being published from time to time, nobody complained. So that was an indication that perhaps it didn't have as much value as it should. You have my promise that we will try to inject as much value as we possibly can. Tonight's presentation will actually close with it, but we're going to talk about the projected return on value and the exploits of Joel Greenblatt, the gentleman there on the left. The stock, basically the stock to study, or the Solomon Select for this month, is Grand Canyon Education. And that's the logo of the one of the units of Grand Canyon University. And the next one over is the featured fund. That's actually from Janus, and it's the Janus Henderson Small Cap Growth Fund. And Herb advises that's actually a logo from his business. I had not ever heard that before, Herb. Apparently, it's for Herb actually ran a chain of janitorial services. Is that accurate, Herb?
No, just one locally here and had over 100 employees. But yeah, it was an interesting thing when you look at Janus, because the Greek god could see both things coming and going, and he was the keeper of the keys.
Okay, well, that's certainly true. The janitors have the keys to everything, so good stuff. All right, we'll do a quick update on Tin Cup, and then we'll kind of revive a little bit our sector radar / GPS, and that's what the graphic on the right has to do with. So let's go ahead and get underway. I see a lot of familiar names, a few newcomers, but a lot of familiar names. You guys know the drill. No investment recommendation is intended. We will definitely be talking about some real companies in real time using our analysis in a mode of demonstration, illustration, and it's for educational purposes only. The key word is demonstration. I'll express opinions. Questions are welcome from the audience if you want something to be clarified or followed up. I do try to remember to disclose when I have a position in the company, but again, they'll be my opinions, and I'll try to remember to do that. We do a monthly roundtable. It was a couple nights ago. Again, thank you again, Herb. If you'd like to have email reminders sent to you for that monthly webcast, please send an email to ncavula1@comcast.net. If you'd like copies of anything, or if you have follow-up questions, or questions about bull sessions, or suggestions for future topics, or expected returns topics, send an email to me, markr@manifestinvesting.com, and thanks to those of you that have actually done that. I actually used a number of emails and pieces of correspondence to refresh a lot of stuff here over the last few days and build out some of what we'll talk about. Here's this month's issue. It has to do with the cover story is Go Go Greenblatt. It has to do with the projected return on value, which we've been crunching away at the better part of 2 years now, and I'm pretty sold on it. And I want to show you why I'm sold, what its potential is, and how we will begin using it in even more going forward. As we said, the stock for this month is Grand Canyon Education. We'll show that to you. That is the result of that stock screen down below about stuff that really matters. I did talk about that a little bit Thursday night, so some of it will be a little bit of a repeat. Again, the featured fund is Janus Henderson Small Cap Growth. Fascinating exchange traded fund. That is an ETF. There's not a whole lot of them even to this day out there yet in the small company world. And that one's been doing pretty well. We will include a moment on the 10 cup demonstration portfolio and a brief discussion of the companies that either ended up on the hot seat or were accumulated this month. In fact, this morning or last night, and talk a little bit about the sector radar or GPS. Any questions in the hopper at this point?
Nope, just welcome to its return.
Okay. All right, so let's start with the screening results. The Sweet 16, I did cover this on Tuesday night during the roundtable, and I admitted that I was thinking about a few kind of special situations with some Chinese companies, including Green Tree Hospitality. I kind of drifted away from that. For one thing, Green Tree has large operations in Wuhan. I'm not sure I'm ready for that yet. I did think about teasing Ken Kavula with a purchase of Ethereum. That's a cryptocurrency, and figured that might not go over very well. Did notice that Amazon isn't on this list, but it's close to being on this list. Amazon's a formidable company and probably always worthy of consideration. So I decided to basically go out there and check for companies that have strong balance sheets, evidenced by their financial strength, rankings being greater than 80%. That's equivalent to an A from Value Line. And then I wanted to focus in on the highest projected return on value, that prove column right down the middle. And that's how I ended up selecting for the roundtable this month Micron Technology. And it only managed to lose 5.5% today, apparently. So if I liked it at 83, I guess I really like it at 80. You know how that goes. We're in it for the long haul, though. I do think that there's a lot of good things happening at Micron Technology, and we'll see how it continues to behave. But as you go down this list, I mean, there's some fairly interesting things going on here. Ken has been interested in the home builders for quite some time. You see one there, two there, and another one down the list. That's kind of hard to ignore. Ken's favorite company, that's actually the convenience store operating out of Canada with a fairly large number of operations in the United States. The Circle K gas stations that you see throughout the Southwest and I think a little bit in the Southeast. Alimentation Couche-Tard shows up, and that is a roundtable selection. Intel is also a roundtable selection. I would have been drawn to Regeneron, but I covered that in last month's newsletter. So we'll let that simmer and go. And what that left me with was Grand Canyon Education, fairly high up on this list, fairly decent return forecast, that 10.6, good quality. It actually is potentially in the buy zone with an upside downside ratio of 3. The current price is less than the buy below price. Value Line likes it with a 10. Morningstar is a little bit less enthusiastic about it, but not bad. And the analyst consensus thinks that it could be on sale by as much as 15%. So again, from left to right, those are some fairly decent characteristics. And because we had covered Regeneron last month, that's also a fairly interesting one. You want to stay abreast of Regeneron. They had a really nice week with their successful CRISPR moment on an actual living patient last week. So the little bump on that news, and their actual business partner had like a 40% ticker symbol NTLA, Intelia. biotech company. All right, so we can come back to that if you have anything that you want to look at there. Here is a quick look at Grand Canyon Education. Again, using the business model analysis to look at it, or the visual analysis, you can see that it has been a little bit wavy, but pretty close to up, straight, and parallel as these types of companies go. Keep in mind that just off the screen here to the left, there was a fairly horrible event in this industry with respect to shenanigans, etc. So you're looking at kind of the aftermath. These guys are one of the survivors. We covered strategic education a few months ago on the roundtable. They also survived as the combination of Strayer and Capella, but really a field of 10 or 12 different educational services companies has dwindled down to a field of 4 or 5 with combinations, mergers, some of them disappearing from the planet, all that kind of stuff going on. So you're looking at that aftermath. Another thing that you notice here is there's a real downdraft here in 2018, 2019. Kind of wonder what that might be all about. And then I look down to the bottom here and I notice this formation. The profitability of this company increased fairly significantly at that same time frame that sales dropped off. So they did something with the business. I want to understand what that's all about. Earnings are fairly steady, remarkably steady, and the stock price has been heebie-jeebie, jittery, upside, downside, all along the way, just what you'd expect from a company like this, where there are a lot of underlying concerns in the back of investors' minds. So you're basically talking about a company with 900 million in sales, growing at about 6.5. That's the slope of this red line again, as we point out. That's the slope of that line. It looks like it basically catches all the points between 2019 out into the forward-looking estimates. So 6.5, 7%, something in that range seems pretty reasonable. After doing some review, and we'll talk about it here in a minute, this 33%, this 30 to 33% projected net margin seems to be something that they can pull off. They have been running around in that realm for the last several years, so whatever they're doing there, I want to understand it, but it seems like it's a viable situation. They have bought back a few shares, taken a few shares off the table. The PE ratio, because of the improving characteristics, anytime you have straight earnings lines like this, and considering the industry, that's actually fairly straight, they're actually building a level of trust and respect, again, coming out of that cataclysmic industry event 10 years ago. So very high quality ranking, even though this is an industry that many people get pretty severe heartburn over. So the quality is high and the projected annual return is low single digits, or excuse me, low double digits. So some pretty good stuff happening there. Upside downside of about 5. And we see a projected return on value. Again, this reconciles with that projected annual return pretty well. These two numbers we kind of look at simultaneously and compare them. And that gives me a lot of faith that that 20 for that PE could be a fairly reasonable number in conjunction with this picture. So the 20 is comfortable, could be 19, could be 18, but in pretty good shape in general. They have about 75 million in debt. They pay a fairly low amount of annual interest, mortgage payment, if you will. So that crunches out to be about a 4% mortgage. That's not bad at all. And these characteristics down here are pretty good too. So let's talk about the change in the business that apparently happened back in 2018, 2019, and the shift that we see on the graphics and the business model here. In the manifest forum, I actually collected up a series of posts where I'm, giving you the current condition. Here's that value line close. They like the company. They think that it's going to track the broader market in the next 6 to 12 months, but over 3 to 5 years, the company offers above average capital appreciation potential. We like that as long-term investors. So long-term investors, if you can warm up to who these guys are, as a agent of the for-profit education industry, could be a company that you look at. I also understand if you'd prefer not to. So that looks pretty good to me. Farther down the page, explaining the step change in the net profit margin. That this box right here that we're looking at and wondering, well, what in the world's going on there? Well, they basically had a complete change of business model. They transitioned from being the parent company of that actual university, school, into what is now a company that provides services and consulting to, it's actually now 25. This is a number back from 2021, I believe. They now are in 25 or 27 different universities, along with a number of other educational entities. They're helping with online education and that kind of stuff. And as you read the materials, they basically profess to a concern about, undergraduate education taking too long, being too expensive, leading down a path to where you could never repay your loan because of the earnings potential that you have out in the workforce. And they basically say, we care about all those type of things. They are basically trying to do things which expedite and optimize the educational experience for students. So they have shifted from being the ones who actually do it to providing it to a number of different people. I would compare this, it's kind of a rough comparison, but you may remember back when Qualcomm decided to stop making the actual hardware of cell phones and instead just sell the chips and the programming and basically live off the royalties. It was that pronounced of a very pronounced change in business model for Qualcomm. That's kind of what you're looking at here. They're doing a little bit less in sales volume, but what they are doing is a higher profit margin type activity. It's a little bit bumpier. You can see that apparently running that university was fairly steady state, and you can drive a stake in the ground somewhere around here, and things start getting a little bit more bumpy, but still in an excellent quality range, and the current return forecast is near multi-year highs. So we like that. Notice that one of the questions we often get is I often take the relative, this is projected relative return. I often take that and set that aside because it can be a little bit confusing, but I wanted to leave it in here this time. Anytime that projected relative return is between 5 and 10 on the projected return graphic on the right-hand y-axis, anytime it's in between there, as shaded by this pink area, it's in the sweet spot. So it's actually making its first visit to the sweet spot, other than this moment back here, in this 4 or 5 year period. So anytime you're between that 5 and 10 on projected relative return, this pinkish area is the comparison to the stock market in general. And anytime you're between 5 and 10, you're in the sweet spot. So this company is in the sweet spot and potentially in a buy zone. All right, we can switch gears. Did any questions at this point, Herb, or anything on your mind?
Oh, it's just one of those things that a lot of people stayed home, and some people may have just decided this is the time to get their education. So that could be what's going on, but it still is an issue of online education. A lot of schools, a lot of colleges had to go to it just because they couldn't meet face to face.
Yeah, and I don't see it going away. I mean, it will continue in at least some form of a hybrid. That's true for us. I mean, even if the National Convention pulls off this year for the National Association, I expect, some online version, just like the kids going to college or high school or even elementary school these days. That's going to continue to some extent. Okay, let's go ahead and press on then. Here's the fund manifest. What I have done here is gone in. We for the last several months have been showing you just the most successful, the super investor type funds, and there are 3 of them on this list that do still chime in here. But what you're looking at here instead is the 10 funds that have the highest projected annual return. Okay, and we'll take a closer look at the actual holdings of Janus Henderson small cap growth. As I said, it's a ETF, an exchange traded fund, so it does not have an M. This M in front of these means that it's a traditional mutual fund. Nothing in front of it means that it's an exchange traded fund. So we've got two of them here. It happens to be one of the sector funds we'll talk about here in a few minutes. You can see that it doesn't have quite the 10-year track record. It came around about 5 years ago. And just from left to right, the top line growth, again, just like an investment club or a personal portfolio, this is the weighted average growth of all the holdings in the fund. That's pretty respectable. And I want you to notice that these are all double digits. That's why Ken is always harping about keeping the growth rate of your portfolio up. Now, these guys are going after small companies. Sometimes they're going to be value opportunities, above average quality, but again, not in the good or excellent range. But that's the type of thing that sometimes you have to endure with a small company fund. You can see the purchase price or the cost, and then the current day price for the stock. And here's an annualized total return of 20.2% over that approximately, that's about 4.5 years for Henderson. And they've actually come in at a relative return a little above the market. That is what is shown down here. It's no flash in the pan. These guys have actually been beating the market for pretty much their entire existence. So this is a good list for shopping for funds if you're inclined to do that in your portfolios. It can also be a place to go and see what they actually have as a screening technique looking for stocks to study. There's a number of very good funds on here. I love T. Rowe Price Blue Chip Growth. They've got a pretty good track record over the years. And you can see that there are 3 funds on this list that actually rank among the top 20 of all funds with respect to long-term market-beating performance. So all of those, virtually every company on every fund on this list is a source of potential ideas for further study. Here's a look at the actual holdings ticker by ticker for Janus Henderson. And you'll notice that this one up here and NARI and SWI, by the way, that is the old SolarWinds coming back to life as a publicly traded company. There are a few people here in the room tonight that probably made some money off of SolarWinds a few years ago because we featured it quite prominently and it did very well. And then there's one other one here. Those 4 we will attempt coverage on because we respect what these guys have achieved at Janus Henderson, and we'd like to see what has caught their attention with these ticker symbols. And we obviously want to get SolarWinds back in the fold, figuring out what's going on there. But again, you see an average sales growth of 17%. You can see that, again, with companies like this, earning stability can be a little bit bumpier, but fairly decent quality for a fund like this. And the reason that this is 11.2, not matching the 10.9 on the previous page, that's the difference in the expense ratios, the difference between the two. We take the projected annual return and deduct the expense ratio, which is only 0.3% for this ETF, and that's what gives you this number, and that's why this says net on the fund summary page. So we'll have some fun. So this is kind of a look behind the scenes of how we get ideas to throw some more tickers into coverage at Manifest. And every once in a while, one of them is just a wonderful adventure to join in on.
It's interesting to see Alarm there.
Yeah, Alarm. Is that one that you have followed at all, Herb?
I have not. I just looked at it. Somebody did a stock selection guide, and that was the first time I'd looked at it. It's probably because of the home building thing and people moving from other places into their new communities, and they're looking at putting alarms in instead, so that they have that security.
Yeah, it's a good company. I can't tell you the names of the brands that they represent, but there's a few, and it is home and commercial/industrial building security. And I did present it as a company at a national convention, I want to say maybe 4 years or so ago. And the source of the idea back at that time was Brown Small Company Growth Fund. And Brown is actually probably my favorite small company fund, but they have not been doing extremely well here over the last couple of years. But that's where we got the idea for Alarm, and we'll see how they do. Notice that the Emergent Biosolutions is also there right next to Alarm. All right. I just wanted to share. I mean, this is a company that we have spotted in the past. Like I admitted, we do hold shares in our family of Janus Henderson Small Cap Growth. This is the reason you're looking at it right here. We were searching for exchange-traded funds that handled these smaller companies. These are the companies that we use to go searching for ideas for our best small company stuff every year. You can see here's Brown that I just mentioned. Has a decent track record, although they've hit kind of a speed bump here over the last few years. But there's some wonderful funds on this list. T. Rowe Price, New Horizons, and some of these have really risen to the top of the stack here. Anything with Wasatch. I consider Wasatch to be among the leaders in identifying the best smaller companies to explore, for sure. Okay. Let's go ahead and talk a little bit about Tin Cup. I'm not going to spend a whole lot of time other than to point out that all of the decisions made with Tin Cup are on the Manifest Forum. We'll demonstrate the worksheet here for a second. We did actually spent the entire month of June above or north of $4 million in total assets until June 30th. In fact, until about 2 p.m. on June 30th. And in the afternoon on June 30th, we dropped down into the 3 million area again and closed the month just slightly under 4 million. But we won't fret too much. It's had a heck of a good run. We're still operating at nearly 16% since inception in 1995. And the 5-year rate of return, this just warms my heart. Because I know a lot of you guys are invested in the same type of companies. 5-year rate of return is now 22% versus about 16% for the value line, all of the above arithmetic average. So this is kind of cool to watch, and it's been kind of an enjoyable run. Here are the companies that are in the portfolio. This is how we closed the month. Like I said, we closed slightly less than 4 million. Which kind of disappoints me, but heck, we get to celebrate 4 million and I get ice cream again here one of these days soon. These are sorted as we do every month from highest return forecast to lowest. So the companies on the hot seat are going to be down at this end. We'll talk about EPAM as being on the hot seat, but boy, EPAM has been on quite a run. The companies up at the top are the ones we would consider accumulating, especially when their percent of total assets are low. You can see that Alphabet's Google's almost 10% of the portfolio. Amazon is 10%. EPAM, again, we wouldn't accumulate it at that par, but a 9% position. But these are relatively small, so any of the cash we put in our monthly contribution and basically divided that up between A2 milk, because I'm being stubborn about Australian milk. I still think it's a great idea, although it's been a challenge so far. And then this healthcare company out of Illinois that seems to be running a pretty good show, Addis Home Care, with home care, a lot of hospice type stuff, and quality care in a number of states, and they're very strategic, and they seem to be running a pretty good business. Again, it's in the minefield of healthcare. We've been worried about healthcare and some of the social healthcare insurance, Medicare, Medicaid, for many decades. It's not exactly a new thing. So it's a matter of figuring out who's doing it well, and they seem to be pushing the right buttons. I did actually listen. I don't listen to a lot of company conference calls when they report their operating results. I did listen in on on Addis at their most recent Zoom call with the three guys sitting around the conference table, and was pretty much satisfied with the types of things they had to say. Only other thing
So
here.
what about Gentex in there? It seems that that's not doing a whole lot lately. I'm not sure. Isn't that automotive?
Yeah, Gentex is automotive. They do rearview mirrors and glass and a few other things for cars. They do the garage door openers and the interface with the homes and all that kind of stuff. They also do a bunch of stuff with recreational vehicles. And as of the last couple of years, they do a whole bunch of stuff with helmets and military applications and that type of stuff, and face masks.
Yeah, I'm just surprised that it hasn't done any better than what it has,
Yeah,
even though the quality is really good. The earnings per share are excellent. Financial strength is excellent. It's just a good quality company, but this just seems to, especially with the RV industry, I mean, they can't even keep RVs on the lot.
yeah. It seems like they pause and kind of take a break every few years or so, and they seem to have been in one of those. We did add shares. We accumulated shares in Gentex last month, I believe, or
Oh,
within the last couple of months for this portfolio, and it is a roundtable holding. Ken selected it a few years ago, and it's actually over the long term, it's performed quite well. It does go through these periods of sluggishness, which again is probably uh, almost an emotional reaction to their affiliation with the automotive industry.
hmm.
I don't know. I'm not terribly concerned. Here's Ann Manning's selection of Axos in the middle of the 10 cup portfolio. And here's my moment of humility. Ken and I bought the same number of shares 11 months ago of these two banks, and I was winning for 10 months. And he's pulled into a fairly sizable lead as Great Southern has stumbled a bit here in the last couple of months. That's our run for the roses. But if you'd have told me that we could invest 100, because we put $50,000 into each one back July of last year, if you would have told me that we'd have $160,000 from that $100,000 investment investing in these two banks, I would have thought you were crazy. But we do. And those banks that Ken chose and defended 18 months ago, oh my gosh. All right, here's a quick look at the worksheet. If you're not familiar with this, within any portfolio or dashboard at Manifest Investing, you can go into a what if, we call it a sandbox or a worksheet, where you can basically play theoretical games. The game here was one, think about, should we sell EPAM systems? Answer, no. Even though the sweet spot is not triggered down here, it's close. We're within 0.1. Quality's fine. Growth is just a tiny bit low. We'd love to bring more growth to the portfolio. And getting rid of EPAM certainly is not going to help that. They've got a growth rate somewhere around 20%. So we're basically looking at the situation of adding to these two. We added a few shares to A2 Milk, added a few shares to Addis Home Care, and basically we'll just let the portfolio go back on autopilot and cook. Here's a quick look at a company on the hot seat, and hot is the perfect adjective for this company. They have their moments too. They hit some speed bumps towards the end of 2019 and through much of 2020, but you can see they're back on track. I called them a poster child for up, straight, and parallel. That could show up on tapestries in mid-Michigan. Those patterns. It doesn't get much more up, straight, and parallel across the board, top to bottom, than this company. And it has had a spectacular run. You can see that in a matter of 4 months, call it 5 months, the stock price has gone from 350 to 510, and that's what's driven the return forecast down to 2.6. Again, the portfolio is right on the edge of needing a little bit of a boost. I would be disinclined or reluctant to sell a company like this unless its projected annual return got down close to zero, certainly less than money market rates. And so that's the decision. Just hang in there. Expect that this might be a bit sluggish, but it's had a heck of a run, and probably not time to sell it, at least not on its own merits, and the portfolio doesn't need a whole lot. Notice that the projected return on value for this one also reconciles pretty well. So that gives me confidence that this PE ratio is somewhat feasible, even though it's relatively high. But look at the numbers over here. It has been living up at those levels. Can't do it forever, but it's doing it right now. And so the decision is basically hang on and hope that they don't have too bad of a corrective moment. As this company was going through its trials and tribulations, we kept urging, and in fact, Cy kept urging, saying, hey, when the global economy begins to improve, these guys are going to get more of their consulting business and everything's going to be okay. And that has happened. Let's hope that it continues to keep happening, and perhaps this company can keep firing on all cylinders. So that's the company on the hot seat, and just hang on to it.
This is a direct competition with CTSH, which is a real favorite for a lot of people in investment clubs.
Yeah, we're finding that some people sold off their CTSH, Cognizant Technology, and switched over here. Yeah, it's in that family. Accenture, trying to think what's in Infosys Technology. All of those companies are actually doing pretty well collectively. And they are thriving because of the need to deploy some of this stuff that's been the technology and the stuff we were talking about, universities and schools earlier. Apply that to the business world too.
Wasn't that one of those companies who were having a lot of trouble trying to find employees to work for them, but the technology has taken over and they don't need as many employees?
Yeah, it's all of those things are happening. It's not easy. In fact, I had a discussion recently with a human resources executive who they now have to begin to assess how productive a person is likely to be working from anywhere. They've never had to really, it's kind of a new skill in many ways for a traditional office position to be, working out of the dining room. How well will that person do there? And they have to kind of figure that out now so that it don't put people in positions to perform badly.
Yeah, our Burger King just was knocked down, and they're going to rebuild it. And I understand it's going to be drive-through only.
I'm not surprised.
Yep, they just can't get enough employees and they're offering $15 an hour plus a signing bonus.
You're supposed to be going to Moomers anyhow.
Hey, on my 80th birthday, the 20th of July, I get 80% off. That's where I'm going.
That's where you're going. Okay. All right. And just to calm everybody down, we close today. This is just one day from that result you were just looking at a couple dashboards ago. We're back at 4 million. Here was today. And I would take that in my retirement account. Pretty good from top to bottom. Notice that there are a lot of the companies in the 10 cup trading towards the high end of their 52-week range. And the two that we accumulated, notice here's Addis and here is A2 Milk. Again, we're shopping at the other end of that 52-week range. Kind of fun. This happens to be a Finance Yahoo chart. And this, of course,
your A2 milk is still, it's got a long ways before it ever becomes profitable and becoming accepted, even though they're on the shelves of some of the local stores.
I agree. Just crossing our fingers and hoping. All right, let's talk a little bit about our sector radar. Again, these are the S&P traditional sectors. There are 11 now that they've broken out real estate from the financials. And what I've done here is sorted them from, again, highest to lowest projected annual return, suggesting that the ones at the top are where there's going to be, you're going to be more likely to find buy zone opportunities. Communications, technology, discretionary, that's the retail sector. Energy, because of how badly hammered it's been. There are probably companies in energy that are very attractive if you can find the justification in the stomach for it. Healthcare, and just notice that it's kind of that traditional group up at the top. Of those 11, those top 5 or 6 sectors are going to dominate most of our portfolios, and there's nothing wrong with that. As the guy from Brown Small Company said, they've been doing this since 1970. They've never owned a financial stock. They are agnostic with respect to sector, and they just simply don't understand them. Don't think they belong in the Brown Small Company portfolio. So that can be true for any of us. I would just urge everybody to go where the opportunities are, and what you will find if you are truly investing regularly, like any investment club, you are going to basically auto diversify because of the way that the stock market revolves and rotates, and just take advantage of it as you go. Notice that there are only 3 of these sectors that have beaten the stock market out of these 11 over the last, this is 10 years, 10-year performance.
Mark, can you go back and look at the pie chart for your tin cup that you have?
I can. Want me to jump off and do that?
Yeah, would you? I think that would be interesting for people to see.
I think I can if I can navigate to where I can get to manifest. There we go. Okay, what I'm going to do is go to, did you want tin cup or did you want round table?
Either one.
Let's do round table. It's a whole bunch of companies, but you can see, you'll be able to see the companies that are here. And what's on your mind with respect to the sector diversification, Herb?
Well, it's
Interesting that the majority, like you said, is technologies and financials and healthcare, and they're showing up right there in your pie chart. And your size diversification shows that you've done a really good job, even in the size. You got the larger companies are the smaller amount, and the medium and faster companies are the higher growth, and that's why you're getting the growth that you're getting to be able to get to that $445,000.
Mm-hmm. Yeah, we're at almost 12% for the average growth. One of the questions that we often will get will be about like a slice of the pie like this for technology. Do I think that's too much? I don't. For one thing, some of those companies are kind of crossover type companies. It used to be true with Amazon, then they moved to Amazon. But I don't think that's too much technology. I think for investors who invest like we do, unless you start getting up to, I want to say 60%, 50-60% in technology, you probably don't have too much. Now, it's all personal taste. One of the things we discovered a few years ago is that the average Michigan club has a higher slice for discretionary than most places nationwide. It's a cultural thing, I guess. So again, if you're wondering about that, the one other thing I would urge you to do is go back and read, go up to here, and use the site search, not the stock search, and look at David Gardner. He's one of the Motley Fools. And this article here on breaking the rules. First, break the rules. There's David looking at us. It basically explains why this is okay. For an assertive investor with risk tolerance and an understanding of what's going on. And that actually stops short of 60%, like I was just saying. And the reason being, look at the companies that are in his portfolio, at least back in that time frame. So if you have qualms about that type of a dominance for a particular sector, take a look at that article.
Well, I think it's important that we don't just look at sectors and size, but also at the companies that are going to do the best growth for us. But they are the ones that are going into those arenas. So, I mean, they're making more money. They're getting farther ahead. So, but it's still, when you start looking at your stock search, look at your portfolio and determine where best to be able to go after some of those stocks to be able to make sure your portfolio is going to continue to beat the market.
Yeah, and just be be aware of it. I mean, I was in the Mutual Club of Detroit. We had way too many banks and insurance companies, and probably didn't fare too well in the early 2000s. Well, it's 2007 yet. I'm sure it was a nightmare. So yeah, you just want to watch for that sort of thing. Overexposure to any particular company, industry, or sector, but don't lay awake at night over it.
No.
Here's the distribution in the S&P 500. And again, we don't urge you to match these distributions. This is how they're spread out. You can see that it's dominated by, communication and technology, but pretty good slice of healthcare there too. But again, you don't have to chase this. You don't have to achieve the averages. You don't have to have a utility simply because there's a number here. Get a utility because it's the right thing to do at the right time. And I think it could be. Pat Donnelly selected a utility for the most recent panel and is doing fairly well. All right. I'm not sure I put this one in there, but I ran into it while I was knocking around this afternoon. I always like that quote. That's from one of the elves on Lou Rukeyser, and I'm going to forget now, but something that Peter Lynch obviously agreed with. And I just every time I see this situation that he's describing here, I just can't believe it. I mean, he had friends, neighbors, actual neighbors that lost money while he's cranking out 29% per year because they were performance chasing and panicking, and they would wait for it to go up a few 100%, and then they would jump back in because there was fear of missing out, FOMO, fear of missing out, and then just invest regularly. And when somebody's
stop trying to time the market.
Yeah, and when Peter's doing 29% a year, just let him do it, and do it within your club, whatever. Just don't try to do that stuff. All right, let's go ahead and close with a few moments on this projected return on value. You've heard us talk about. Many of you are quite familiar with it, but I just want to kind of put a cap on it. And here over the month of July, as we're implementing some of our software stuff at the site, at the Manifest Investing website, we're going to incorporate some of this stuff. So I just want you to be prepared for it. We're not kidding around here. This is it, the one metric you should know about. Some people who really know what they're doing, including the author of that book, Joel Greenblatt. They use different forms of this. We're actually doing an interpretation of it that's SSG centric, but it is faithful to the concept that they're talking about and the types of things that these guys do with their earnings before interest and taxes and enterprise value and that kind of stuff. And Warren Buffett basically calculates the value of businesses using a very similar methodology. So what is it? Why should we care? And how is it actually done? How is that calculation done? Let's tackle that. Here's who Greenblatt is. He's actually a professor at Columbia University. He ran a hedge fund for 20 years, achieved 27% returns according to the data provided in that book, Excess Returns, which I have. It's on my nightstand every time I have trouble sleeping. But it's a great book. I became familiar with it thanks to Jim Clunan over at the American Association of Investors, and his book on Rule 1? Investing at Level 3. I've got it on the bookshelf right behind me. Investing at Level 3. They mentioned this book, so I went out and got it. Anyhow, Greenblatt, exceptional performance, so he's not just talking theory here. He's actually done it. His actual mutual fund is doing fairly well. Here's what we're talking about. Projected return on value. It's actually consistent with the long-term principles of the stock selection guide at the National Association. The emphasis that Mr. Nicholson had, including his work with Ralph Seeger back in the 1940s and 1950s, was an emphasis on the top line, the green line that you see down here, and mapping the pre-tax income. This says pre-tax income, so section 2A was actually graphed and presented on the front side of the visual analysis. So those were the two things that we looked at. He didn't even graph earnings back then. Think about that. Since these are the talking points we've had for the last 18 months, we've been challenging them, doing research in various areas. We do believe that it's consistent and that this calculation, as we dig into it, is very consistent with leaning on the preferred procedure and understanding the business model. It actually tiptoes around some tax and accounting related disruptions that wreck earnings. Generally accepted accounting principles, I get them, I understand them. I understand tax law, tax code, although I'm not an accountant. I generally understand it. It's reality, but a lot of times it results in some fairly wide fluctuations between what is reported to the government for tax purposes and reality, and how you're going to understand a representative model of a business. So just be aware that that's just a fact. And a lot of times, I've always kind of been under the notion that the stock selection guide is a very income statement driven device, and it doesn't pay enough attention to the debt capital situation. And this requires that you do that. We discovered that the results of that calculation for Prove actually compare pretty favorably to what we expect with a projected annual return, Section 5 from a stock selection guide. Some of the dynamics of the calculation itself means that it will enable, it certainly supports, earlier analysis of companies like Amazon, Tesla, companies like that over the years, Netflix, companies that don't have earnings yet, Hugh McManus type companies in some cases. Now, if that causes you to lose sleep, don't do it. But it is a field of opportunity, can be a minefield, but it is a field of opportunity where you can have wonderful results. Witness the 2-time selection of Amazon for the round table. It's now worth $2,000 is now worth $30,000 thanks to Hugh. And the last point, you actually calculate the projected return on value without ever touching a PE ratio. So that's also compelling for a number of reasons. All right, so there's the calculation. Again, just reminding that it is an output of our traditional analysis. And our traditional analysis is to focus in on the sales trend and the growth rates and all that kind of stuff. And there's just this reality that stock prices can be volatile and deviate and all that kind of stuff. But over the long term, a stock's average annualized returns will tend to approach the underlying business's return on invested capital. That's a cousin to what we're talking about. So it's a different flavor, but it's closely related. We'll come back to the calculation here in a minute. But here graphically is what we're talking about doing. You do your stock selection guide, you come up with a projected pre-tax income. That's basically the 5-year forecast is that point right there. That basically represents, if you look at this 10-year period, that is the average for this 10-year period. So it's the average projected pre-tax income over the next 10 years, and you're basically making a comparison to the enterprise value, which is these 3 components, and we'll cover it a couple of times. The stock price. So a higher stock price actually drives down. If the stock price goes up and nothing else changes, it's driving down the projected return on value. One of the differences that we discovered when we were working on this is Greenblatt uses the long-term debt. We found that in using long-term debt, we encountered still a lot of noise in the data and a lot of funkiness, and highly technical term there. And what we discovered is you can't look at just long-term debt. You have to pay attention to and I'm using air quotes here, the credit cards that a company has. Different kinds of debt, different types of capitalized leases, all that kind of stuff. We said, we'll just throw them all in one thing called total liabilities. Don't worry about whether it's long-term debt or credit card debt or that kind of stuff. It's all a liability. So look at it all. When we did that, the data magnificently transformed into something more credible, probably something more useful. And then there's also this notion of companies with a bunch of cash on their balance sheet. You basically have to account for that in how you look at the value of a company. It's just like you're buying a wallet. Well, how many dollars are in the wallet, and that sort of thing. So that's what the calculation boils down to. That's the graphic representation of it. We said that back when we started this effort, we compared the return forecast, the Section 5 projected annual returns, to the projected return on value. We noticed that this actually seemed to be fairly more consistent, more like a bell curve, and that this one was a bit noisy. The reason it's noisy is because PEs and various things cause that to happen, basically kind of wrecking the situation with some volatility. And as we have refined the data, used this to do some conditioning of stuff that looks really weird, again, keeping in mind that you're bringing in the debt component to it, it's just gotten better and better. Here's a fairly current look. I'm going to do another look here in a few days. Again, that's just fairly tight, and we want to focus in on, here are the buying opportunities, here are the selling opportunities, and it's actually fairly straightforward. So here's what it looks like as we crunch through the numbers of an analysis. This is a stock selection guide. It's a numerical stock selection guide where basically the sales growth forecast, the net margin, and the PE ratio generate a projected annual return. And what you see down here is the only numbers you need to do a projected return on value calculation is the stock price, which we have, the tax rate, which can come from a place like Value Line, the cash on hand from a data source, and that in this case, that's in billions over there, so you have to adjust it to millions, and total liabilities. Like we said, I don't care whether it's credit cards or long-term debt, what are the total liabilities? And so these are the only numbers you need. And you can calculate the projected return on value, and in this case, for whatever company this one is, I believe it's Clorox, the projected return on value actually begins to resemble the projected annual return. In fact, if I'm doing a study, I might consider maybe this should be 20 for a PE. If I'm actually doing my own SSG, this 22 is probably straight from Value Line. So it allows you to take a look at these two numbers and reconcile one versus the other. Again, they should be resembling each other. This one down here never touches a PE, so it becomes a natural second check. That's why Ken is talking about using it to reconcile or condition PEs, as you see right here. Might consider doing that in this case, but that's close enough. It is close enough. You don't want to dance on the head of a pin with the angels here. So that's really what it boils down to. Fewer numbers going into the calculation, fewer numbers that can be played with. It can actually come back full circle and audit or condition a PE ratio. Say, for example, we did the calculation and the projected annual return, instead of 8.5% here, was 28. And the PE, according to the analyst, was 45. Well, and then we crunch through the projected return on value and we get this number. We have questions. And I would start with the PE ratio and start cranking that down in my study. So it's a potentially very valuable addition to the stock selection guide process, and it could really help in what can be a very mysterious and challenging area when it comes to selecting PEs. So with that, I'll go ahead and leave the bibliography that Ken and I shared after our successful investing session. All of this stuff is still good. It all still aligns up. Cy does a great job of reinforcing traditions and the preferred procedure there. I confess about leaving money in the pockets of coats at a garage sale, far more than the value of the coat. So have fun with that. All right, so we can actually take some questions here, but I just again want to issue our traditional reminder that we do archive all of these sessions, and including the bull sessions and the roundtable at YouTube under Manifest Investing, and I would encourage you to explore that and check it out. So with that, Herb, I think I'll go ahead and shut down the recording, see if there are any questions.